Good morning, everyone. Welcome to the Reserve Bank and to the November Monetary Policy Statement. I have with me Jeff Baskand, Deputy Governor, Head of Financial Stability, and John McDermott, Assistant Governor and Head of Economics. And today the Reserve Bank is leaving the official cash rate unchanged at 1.75%. This decision is made under the current Policy Targets Agreement, which I signed with the Minister on Tuesday. That agreement you will find on the inside cover of our published statement. Our decision is also in the context of the economic outlook, which overall is very positive. Looking at the global economy, the growth outlook is improving and inflation remains subdued. Commodity prices are relatively stable. Monetary policy and interest rates remain easy in the advanced economies, but that stimulus is gradually being removed. The exchange rate has eased since the August statement, and if sustained, will increase tradables inflation and promote more balanced growth. In the domestic economy, we're seeing strong employment growth, and GDP growth is projected to strengthen over the forecast period. We now have a weaker outlook for housing and construction, but this is offset by a continued high terms of trade and increased fiscal stimulus. In these forecasts, we have included estimates of the impact of new government policies in 4 areas. New government spending, the Kiwi Build program, tighter visa requirements, and increases in the minimum wage. The impact of these policies is essentially a first estimate, and these numbers remain very uncertain. House price inflation has moderated due to a number of factors: the LVR restrictions, affordability constraints, reduced foreign demand, and a tightening in credit conditions. Low house price inflation is expected to continue, reinforced by new government policies around housing. CPI inflation was 1.9% in September, although underlying inflation remains more subdued. Non-tradables inflation is moderate but expected to rise as capacity pressures increase. Tradables inflation, on the other hand, is relatively high now due to the lower exchange rate and increased oil prices, but this is expected to soften given our projection of ongoing low global inflation. We're forecasting overall CPI inflation to remain near the midpoint of the target range over the next 3 years. Certainly, longer-term inflation expectations are well anchored at 2%. Monetary policy will remain accommodative for a considerable period. However, numerous uncertainties remain, and policy may need to adjust accordingly. So now let's open up to see if you have any questions.
You're making some assumptions here on that people will carry their previous expectations of inflation through, and that you're not going to see a turn in behaviour. How provisional is that assumption? Because there's quite a lot riding on it, isn't there?
Well, inflation expectations are very important. I'll ask John to follow up on this. And, you know, in recent years with low inflation outcomes, that has had quite a bit of momentum in the system. But as I mentioned, the long-term inflation expectations have been stayed close to our 2% midpoint, which is very positive from our point of view. So we think that those that experience and that those expectations that 1 to 3% inflation is now normal, 2% is normal, and we're not about to deviate from that. That really assists our policy, and we want to ensure that that element is retained in the policy framework. Do you have anything to add to that, John?
Yeah, it is an important issue, but I think the way you phrased the question was, what do you think people are going to think in the future, which is always tricky. As you well know, inflation expectations are a critical part of monetary policy formulation and the inflation process. And we'll be looking at monitoring that as intensively as we have in the past, by monitoring, financial market prices. We'll be paying very close attention to all the surveys on inflation expectations and also to our internal models of inflation expectations, which have proven to be a valuable part of getting the inflation forecast right over the last couple of years.
Governor, a couple of quick questions on the new forecasts today. You now expect inflation to reach the midpoint of your target a lot sooner, so next year. But you haven't made a really significant change to the outlook for the OCR. Could you explain that? Why the OCR remains on hold for so long, even though you expect to reach the 2% a lot sooner?
Well, these forecasts have sort of got quite a few moving parts, and there's give and take on different things. So quite a few things have changed since our August MPS, even though at the end of the day there's a lot sort of netting out so that the interest rate track is very close to what it was before. I think in terms of the inflation, we have seen stronger traded goods inflation because of, one, the lower exchange rate, and two, higher commodity prices, high oil prices, and I think maybe some food price increases as well. So they've lifted the inflation track sooner than we had before. But we see that sort of dissipating, that traded goods inflation, to be replaced by the underlying trend in sort of non-traded inflation, which was the driver of our previous track, sort of coming through more gradually. So there's sort of a replacement of one with the other as we move through time.
In the past, the Reserve Bank has looked at how the migration changes in the last few years have affected inflation in the labour market, and that the large number of particularly young migrants in the last few years has helped increase the labour supply and therefore surprised a few people by not increasing inflation as perhaps it was expected in the past. Given this 20 to 30,000 projected cut in net migration from government policy changes, what sort of inflation impact do you think that might have? Because on the face of it, it could, in theory, slow demand and slow the economy and inflation, but on the other side, reduce supply and potentially increase wages. So how do you see that balance?
Do you want to try that?
Yeah, I mean, this is the point I was referring to earlier. I mean, what matters here is the composition element of the arrivals and departures. So whether they're young, whether they're entering the labour force, or how much demand, aggregate demand extra to the economy, which is what you referred to. And it was a big change. So we had last time the net migration profile actually didn't really add to aggregate demand as much as the previous two cycles. And I think we're going to have to be on guard for the same type of phenomena this time. Is where does the net demand and supply profile go? For the moment, in these forecasts, what we're assuming is that the two forces roughly cancel each other out. So there's a very, very small change on net in terms of its pressure on resources and inflationary pressure. It could well change, and then, but the key to understanding that change will be to see who is arriving, who is leaving, what are the age profiles, do they have work visas, what skills do they bring, and a whole raft of other sort of criteria.